Now that we understand factors that drive bond yields and central bank rate setting, we are ready to discuss the yield curve, a visual representation of the cost of borrowing. Let's bring up two Bloomberg screens simultaneously. First, let's type World Bond Markets and select WB to see the yields on the most important government bonds. Then, let's bring up the yield curve by typing yield curve into the command line and selecting the Graph Curves or GC function. This is the United States government yield curve. The x-axis is the bond's maturity, ranging from 1 month all the way to 30 years. The y-axis is the bond's yield, the interest rate that an investor would get per year from holding that bond for the full life of the bond. The x-axis of the yield curve confuses many people. It does not signify the passage of time, but rather bonds of varying maturities. This chart, therefore, simply takes the yields on various U.S. government bonds at the same moment in time and plots their yields. At this point in time, the two screens show us that 2-year U.S. yields are 0.416%, 5-year are 1.574%, 10-year are 2.402%, and 30-year are 3.192%. The first thing you notice about the yield curve is that it is upwardly sloping, with the shorter maturity bonds to the left having markedly lower yields than the longer maturity bonds to the right. You already know why long-term debt is more expensive to borrowers. There is a greater chance of the borrower going bust, and the lender is more exposed to the corrosive effects of inflation. In addition, inflation becomes harder to predict the further into the future you are trying to predict it. Let's pull up the economic forecast function, ECFC, once more and look at the inflation forecast for the United States taken in mid-2017. As we can see, analysts estimated that 2017 inflation would be between 1.5% and 3.7%. For 2019, the band of estimates was broader, ranging from a low of 1.8% to a high of 4.5%. Imagine the uncertainty over 30 years. No wonder 30-year bonds have higher yields than 2-year bonds. The difference between the yield on the longer maturity bonds and shorter maturity bonds is called the term premium. This is the extra yield that investors demand for holding longer-term bonds. On the screen shown, the 10-year to 3-month term premium is 2.374 percentage points, which is the 10-year yield minus the 3-month yield. We saw in the Economic Indicators module how investors maintain economic estimates on ECFC. We saw in the Currencies module currency pair estimates on FXFC. In the same way, analysts maintain estimates on bond yields. Let's type bond yield forecasts into the command line and select the BYFC function. Taking the U.S., for example, here we can see forecasts all along the yield curve for the Fed funds target rate, 3-month rates, 2-year rates, 10-year rates, and 30-year rates. The yield curve seems obscure to newcomers to finance. It is anything but. It represents the cost of borrowing, and therefore it reverberates throughout the markets and the world economy. We already caught a glimpse of this earlier with the Amazon analogy. When the Fed alters the left-hand end of the yield curve, short-term interest rates, it affects prices and yields of the whole $101 trillion bond market. Let's discuss how the yield curve impacts corporations, consumers, and the world economy. First, corporate impact. Almost all corporate investment projects are multi-year. They are therefore typically funded with medium or long-term borrowing to match the project duration. Lenders to companies face the same risks as lenders to governments. Short-term interest rates may rise and inflation may rise, both of which will dent the price of the bond for the lender. But in addition, lenders to companies face the elevated risk of the companies going bust. This is because companies are typically less creditworthy than governments. Therefore, corporate bonds typically have higher yields than government bonds of the same maturity. This is called the spread. A spread measures how much more a business pays to borrow money than the government does. Let's demonstrate what we mean by spread. We'll begin with the U.S. government yield curve by typing yield curve and selecting the GC, or graph curves, function. Let's add the yield curve for breakfast cereal manufacturer Kellogg by typing Kellogg into the curve selector. Then, let's look more closely at the curves. The blue line is the yield curve for Kellogg. Kellogg has many corporate bonds outstanding of many different maturities. The spread is simply the gap between the two curves. At the 30-year maturity point, the Kellogg bond is trading at a 5.0% yield. Meanwhile, the 30-year U.S. Treasury bond is trading at a 3.2% yield at the time shown. Therefore, the spread at the 30-year point is 1.8 percentage points, or 180 basis points, otherwise known in the market as 180 bips. Now let's see what happens when the government yield curve moves. Let's overlay both the U.S. government yield curve and the Kellogg yield curve a year earlier. If we look at the spread between the government yield curve and this corporate yield curve, we can see that while both yield curves rose a lot over the one-year period, the spread remained relatively constant. Let's look at the yields at the 30-year mark on the right-hand side of the chart. In year 1, the government 30-year yield was 3%. By year 2, this had moved up by 0.2 percentage points to 3.2%. In year 1, the Kellogg 30-year yield was 4.8%, and by year 2, this had moved up by 0.2 percentage points to 5.0%. The spread, therefore, was 1.8 percentage points in year 1, and by year 2, it was 1.8 percentage points. This shows how government yield curves underlie the cost of borrowing for companies. Often, the cost of borrowing for companies will change when the cost of borrowing for the government changes. And what happens when companies borrow and commence large projects? Why, GDP growth, of course. The yield curve therefore affects economic growth through regulating the cost of company borrowing. Government yield curve moves. Let's overlay both the U.S. government yield curve and the Kellogg yield curve a year earlier. If we look at the spread between the government yield curve and this corporate yield curve, we can see that while both yield curves rose a lot over the one-year period, the spread remained relatively constant. Let's look at the yields at the 30-year mark on the right-hand side of the chart. In year 1, the government 30-year yield was 3%. By year 2, this had moved up by 0.2 percentage points to 3.2%. In year 1, the Kellogg 30-year yield was 4.8%, and by year 2, this had moved up by 0.2 percentage points to 5.0%. The spread, therefore, was 1.8 percentage points in year 1, and by year 2, it was 1.8 percentage points. This shows how government yield curves underlie the cost of borrowing for companies. Often, the cost of borrowing for companies will change when the cost of borrowing for the government changes. And what happens when companies borrow and commence large projects? Why, GDP growth, of course. The yield curve therefore affects economic growth through regulating the cost of company borrowing. In this chart, the white line represents the U.S. government 10-year bond yield, while the orange line represents the overall yield on U.S. corporate debt. The x-axis represents the passage of time. The gap between the white line and the orange line is called the corporate spread. We saw earlier the disproportionate importance that housing has on the U.S. economy and on the behavior of consumers. Most house buyers in the U.S. get a 30-year fixed-rate mortgage. This is priced off 10-year government bond yields. Let's pull up the U.S. government 10-year bond yield going back to the late 90s period. Now, let's plot the effective interest rates on 30-year mortgages available over this period. The white line represents the yield on 10-year government bonds over time. The orange line represents the interest rate of 30-year mortgages in the U.S. Witness the consistent spread between the cost of 30-year mortgages and the yield on 10-year U.S. government bonds. Government bond yields therefore influence the affordability of homes and the overall level of activity in the housing market. And as we saw earlier, when people buy a house, they tend to spend a lot of money on things like furniture and paint, and this drives GDP growth. There is also a second-order effect. At some point, the crush of new buyers will eventually send house prices up, which will make existing homeowners feel wealthier and thus more likely to spend more on things like vacations and fancy restaurants. After all, why save for retirement when the price of your house is skyrocketing? Trade is not the only factor that makes the world's economies move in the same direction. So do yield curves. If we plot the 10-year bond yields of several advanced economies, we see that they are strongly correlated. The fact that government bond yields tend to move in sync means that the world's economies tend to be stimulated or depressed in sync. Think you've grasped these concepts? Answer these questions to check your understanding. To summarize, the yield curve is a depiction of the cost of borrowing for various periods of time. The natural order is for the yield curve to go from bottom left to top right because there is a greater chance of stuff going wrong over the long run. When companies borrow, the interest rates on the bonds are set in reference to the government borrowing rate. When consumers borrow to make big-ticket purchases, the interest rate they pay is also set in reference to the government borrowing rate. The correlation between government bond yields around the world has the tendency to link economic performance of the major economies.